Okay, welcome to MBA 507. My name is Charles McCarr. I will be your instructor this semester, and we'll take a little bit of time here going over some of the administrative stuff, the syllabus, and then we'll get into chapter one. It's a very short chapter, an introductory chapter, and so this will be a short session, probably about an hour, maybe a little less, a little bit longer. What I like to do with these YouTube videos is not turn them longer than an hour and 15 minutes. I know you guys can stop and start them when you're viewing them. But again, if I do the whole 2.5 hours in one video, that's a little bit too much. So I'll break them up around an hour, give or take 5-10 minutes, one way or the other. Throughout the semester, some of the other chapters will probably run three videos for approximately 2.5 hours or so. So I'll break those into 15-minute sections, something like this. But I sent the syllabus out to all of you, I believe, and in the last several days. I also have it posted on a Blackboard. I will be sending out other stuff relative to each chapter, usually the weekend before the week starts. So you'll give you the week plus the following weekend to get over the material and get the submissions due. And I know a lot of you are probably working, and hopefully this will give you a little bit more flexibility of doing it this way, having a asynchronous online format as opposed to synchronous where we'd have to be there all at the same time. This way you can move it around. Like to focus your attention on, I believe, page 3 of the syllabus, the evaluation methods. You're going to have a midterm and a final exam, and you're going to have to do a paper. The paper has to do with some aspect of finance. In the past, I've had a lot of marketing people hand me papers that are more of a marketing nature. You can pick a company, and a lot of people pick Amazon and tell me that it grew great and all this, but they didn't tell me how they grew, how they financed. This is a little bit of a, what's the name of the course? Accounting and Finance for Business Leaders. It is not marketing. It is not human services. I also, the first time I taught this in a hybrid fashion, we did meet every day, every fourth Saturday from 9 in the morning until 4 in the afternoon, and the 3 weeks in between, we would do online. We did that for 4 months in the summer. And one student gave me a paper on, it was a biographical paper on the fellow that was at the time head of Fannie Mae. Well, Fannie Mae is a financing organization dealing with mortgages, a quasi-governmental organization. But basically, she did a biographical, historical type paper on the person who was the director, and really didn't get into how they set their interest rates, how they collect their money, how they raise their money, their sources of the money, and everything else that we should be interested in a finance course. Okay. Again, for a lot of you are probably leery of the course just by its name. When I teach this, we are going to do some numbers, but we're not going to get heavy into the numbers. When you get out in the real world, as most of you are already involved in your careers, when you need the numbers crunched, that's when you call a guy like me. I'm a CPA, and all my life we've been crunching numbers. You can hire people to do the number crunching for you. My aim at this course is that you know what the numbers mean, and you know when to ask for certain numbers and be able to interpret them. Okay. Again, you can always get somebody to do certain things for you. It's having the knowledge to know what you need and what to do and how to process that information that I think is the utmost important. So even though we're going to do some number crunching, and you don't have to get a financial calculator, it will be beneficial. The textbook, when we get to places where we have to do some number crunching, it will show you how to do it with I think a business analyst too, which is a Texas Instruments, I believe. It's also available. A lot of the number formula crunching is now available in Excel. So if you have a computer with Excel on it, and I'll also, when we get to present value, future value, I'll give you advice on how to go, whatever web browser you use, to do it the old-fashioned way, where you can. Back in my day when I was a student, we would get a book that was about the size of a Reader's Digest, maybe a little bit smaller, and all it had was numbers, factors for the present value, future values, in 1/8 of a percentage increment from 1/8 of a percent up to like 20%, from 0 up to 40 or 50 years. Again, these things are at our fingertips. I will give you references to whatever search engine you want to get your present value, future value tables. The ones online now are severely limited. They usually only work in half or quarter percent increments and usually go from 0 to 40 years. But that's not until chapter 4 or 5. But again, we have various ways of doing it, using a financial calculator, using Excel, or doing it the old-fashioned way with just a standard calculator or a piece of paper and the tables that are going to give you the factors. So again, the paper, I would like you to bounce the topic off of me before you start the paper, just so I know that it's going to be somewhat connected with finance or accounting, and not marketing or human resources or history. In fact, the people that had chosen Amazon in the past, I was very disappointed that none of them looked into the relationship that Amazon has established with Tesla, making I forget, was $160 million or $400 million investment in Tesla. And obviously they're looking at going to electric delivery vehicles, which makes a lot of sense with limited range of electric vehicles right now, where you can charge them overnight and use them 12 hours, charge them 12 hours. So that's, again, get a relationship established with a soon-to-be vendor of yours, and to get influence with them, and maybe a better price on the product and some input on product designs for your needs. Okay, the student involvement will be based on, you'll see in the syllabus, there are a number of questions and problems in many cases at the end of each chapter, or most chapters. Not all of them have many cases. I want you to work on those and submit them to me. They are not going to be graded per se, but they are going to be, it's sort of like a pass-fail. I just want you to extend an effort on them, and it's required. So if you don't submit all of them, your grade will suffer a little bit. That's only a 10% of your grade, but it can mean a difference of between a B and a B plus, or a B plus and an A minus, or something. It may have an impact. So please try to answer the questions, problems, many cases to the best of your ability. Again, just getting you focused on working on it. Again, because of this course is not assigned or designed for accounting, people with accounting concentrations or finance concentrations in the MBA. I'm not looking to make you wizards with the numbers, but you need to appreciate what the numbers mean, okay, and how to ask for them, when to ask for them, and how to interpret them and work with them. The end of the syllabus, or next to the last page, are the student assignments. I've got to angle it so I don't get reflection off the light here. And it's the review questions, study problems in many cases. And as you can see there, all 13, I don't know if we're going to get through all 13 chapters, but there's review questions on all of them, which we all should be able to handle review questions. Then the study problems, chapters 2 through 13, and be careful, there are, chapter 4, it's parts B and D only, chapter 3, 15, A and C. I think there's one or two where I will give you some information that you don't have to do a lot of calculations to get numbers you need to do the required parts of the thing, the problems. And also the many cases watch, there are excerpts where you don't have to do the whole thing. Chapter 1 being one of them, A, B, C, D, and E. So A, B, C, D, E, F. I don't know what, let me see what I didn't have you do. I think I gave you a break. G, now I have to define them. Okay, so, all right. So basically, that's the syllabus quickly and easily. Any questions or comments on it, drop me an email. I ran spell checker and I did read it quickly, but I am a terrible typist, so I'm sure there may be one or two, if not more, typos on it. Please forgive me. I beg your indulgence on those. So, what is finance? I like this book. I've been using it for 8-9 years now. It's probably the 4th or 5th edition that I've had. The finance, everybody thinks they know what it is, but really, what is it? It's looking at how to get funding. Where do we get the money to operate a business? How to expand a business? And as we go through the textbook chapter by chapter, we'll get into different things into more minute details on the mix. Should we issue stock? Should we borrow money either directly from a bank or from going directly to investors by issuing bonds directly in the financial markets? We'll talk about financial markets, I believe, I don't know if it's chapter 1 or chapter 2, but we'll do it early in the course to give you a background and understanding. So when you're in a meeting, a conference room or something, and you have people from the finance department, people from the marketing department, people from production, people from HR, and I'm sure I apologize, any department I may be missing. They each have their own specialty, their languages, their words they use. So you won't be sitting there thinking, what the heck are they talking about? And you said, oh yeah, I remember hearing that. Oh, I know a little bit about that. And again, you're going to be an expert in your own discipline, but you should be expected in business to have at least the familiarity with the words and terms and concepts used in the other departments that complement you in a business. So again, we have 5 foundations of fundamentals and principles that they introduce us to in chapter 1. And we will see these time and time again throughout the textbook. Sometimes we'll see one, sometimes we'll see more than one. I don't know if there's a chapter other than chapter 1 where they introduce them to us where we see all 5, but I've always advised the students to get a note card and write the principles down and use it as a bookmark. If you have a physical book, if you're using an ebook, well, then I would just keep this and keep it handy with the paper clip or tape it onto my notebook or folder, however you accumulate your papers your notes you're going to be doing throughout the course. Okay, so each week before we do the chapter, or as you do the chapter, I'll be sending out what I call a shell outline. I will, and it just follows the chapter. I usually had these required that you would complete them and send them to me. It's a good review. It makes sure that you're reading the book. It highlights the important topics within the chapter. You can read, but when you write it down, it slows your brain down and a little bit more sticks in it. Students have complimented on its beneficial properties in the past. If you want to do it, fine. Again, that's one of the participation factors in the grading. Again, that's only a 10% factor in your grade. And it will be also sending out PowerPoints and these videos. So between reading the book, watching the video, doing the show outline, looking at the PowerPoints, hopefully something is going to stick in our brains. Okay. Usually the chapters start with a little anecdote from the real world. Chapter 1 uses Apple Computer, and they talk about the great gains. And I think everybody is familiar with, how it started in the garage with Mr. Jobs, and grown into a multinational, multi-billion-dollar company that dominates. Think about it. Apple started out as a computer company, and what are they known for now? They're known for cell phones, smartphones, and other mobile devices, tablets and whatnot. So, I'm not an Apple fan. I don't have an Apple phone. The only thing with Apple was early on, 40 some years ago, we had one for our son so he could do some games and stuff on them. And only did that because at the time they had better graphics than anybody else, but they are well received in the marketplace, leader in their area. And I don't know, what are they up to? iPhone 10, 12, 14 now. Is it planned obsolescence or what? And so how do they time these things? Those are things we are interested in a course like this is, product introduction. Well, it takes a lot of money, a lot of research and development to develop these new products, design them, engineer them, and then also to produce them and market them. So again, it all takes money. Where do we get the source? What's the source of those monies? I don't know. Most of you should be familiar as business students with the name Warren Buffett, the Oracle of Omaha, as he's known. He's up in his 80s now, I guess. Berkshire Hathaway is his company. He sells stock. There's several classes of stock. Some of the stock shares classes, one share will run you, I believe, in excess of $1.2 million for one share. Of course, people probably bought it for $100,000, and it's just gone up in value. So those are some of the things like that we'll be exploring this semester. But if we get far enough into it, we'll be talking about dividends, but there's a chapter on dividends. And both Steve Jobs and Warren Buffett, as well as Henry Ford, detested dividends. We'll see, I believe in chapter 6 or 7, that one of the ways we get to looking at determining a value, a share of stock, one of the things we take into consideration is the dividend payment. Well, not all stocks pay dividends. And Steve Jobs and Warren Buffett and Henry Ford, the reason they didn't like dividends is, what do dividends do? Dividends take asset, usually in the form of cash, out of the company. They make the company smaller. One of the cheapest way of financing would be internally generated. There's, again, only a few limited ways you can obtain funds. Owners can contribute funds, that is, make an investment, an ownership investment, or you can go borrow it, the funds. Well, if you have profitable operations and you retain those funds, that's the cheapest way of financing. So how does it benefit a company to pay some of the earnings out to the shareholders in the form of dividends? All three of those individuals I named earlier really had a dislike, an aversion to dividends. They would rather keep it in the company. Think of it as a pie. When you pay dividends, you're taking a slice out of the pie and giving it to owners instead of leaving it in the company to grow and reinvest. So again, dividends, when the board of directors makes a declaration of dividends, they will usually only pay out typically 25% of the year's earnings or less, depending on company policy. Some companies do it more, some companies do it less. In fact, the Apple shareholders were up in arms that Apple was going great guns and had, I believe, over $500 million, $500 million or $600 million in cash on their balance sheet. And they said, we're flush with cash. Why not distribute some of them? Why not pay some of it to us? Well, they don't realize that if you own the company, you own part of the cash. You have a claim to the assets. So the only thing is, when they're in the company's checking account, only the company can spend it. The shareholders wanted it in their checking accounts so they could spend it personally. All right. So again, it doesn't make you richer or poorer. It just gives you who has custody of, who can access those funds. So again, if you had, let's say you were the sole owner of a corporation that had $1 million in cash on the balance sheet and $10 million in total assets, well, you own it. Well, if you take half of that $1 million, $500,000 out in the form of dividends, the company's $500,000 less worse off, but your $500,000 instead of being in the company is now in your bank account. So you're no richer, nor are you any poorer. It's just a matter of where the money is. Okay. All right. So we have 5 fundamental. I don't want to turn my back on you too much here, but getting glare there. Okay. 1, 2, 3, 4, 5. Okay. Angle it a little bit, maybe get rid of the glare. Okay, the principles, the foundations that are going to guide us, and not just in this course, but in your career. Cash flow is what matters. Okay, so I'm going to have to draw some lines on that to get straighter. And there's a lot of truth in that. Being an accountant, I take a little exception to this, but I really don't have a argument that can counter it. A lot of people say, no, profits are what matter. Well, profits are an accounting concept. If you remember back to your Accounting 101 days, there was a definition, the income statement. Revenues minus expenses equal profits, okay? Income. Well, we use the accrual basis of accounting. So a lot of those revenues might be not collected yet, might be sitting on the balance sheet, not in the cash account, but in the accounts receivable account. Well, if you're an employee that works for that company, come payday, you don't want the company to give you some receivables from people that owe the company money and say, they owe us money, we owe you paycheck, so you go get it from them. No, you want a paycheck. You want cash. Okay. So cash flow is what matters. If somebody's looking for a topic for a paper, it might not be a good one because it's 50 years old. Probably wouldn't be able to find a whole lot on it. But back in the late 60s, early 70s is when the fitness craze, running, jogging craze hit America. And people were starting to go from, especially from regular sneakers, basketball sneakers, to specially designed running shoes. Okay, like track and field athletes would wear, more cushioned. There was a company, they're still around, not New Balance. I can't think of it. Brooks running shoe, Brooks. So anybody in that business was, experiencing a lot of growth. There was an explosion for the demand of their running shoes, cross-training shoes. And they doubled their sales 3 years in a row and went bankrupt doing it. And they were profitable when they were small, but they didn't manage the growth well. Well, you're growing things and you're borrowing money, you're getting in debt. Well, leveraging can be a tool. And like any tool, it can be useful or it can be dangerous. Just be careful, a circular chainsaw, will go through a tree trunk, but it'll also go through your leg. So, yes, it can help you do work, but it can also do great damage. So be careful. One of the tools we use are financial statements provided by guys like me, people in your accounting department, that give you a lot of information. Information is key to making decisions, making good, informed decisions. Okay, but one of the reasons, back in 1973, 74 is when the accounting profession said, hey, 3 financial statements that exist are not getting the job done. We had the balance sheet, the income statement, and the statement of retained earnings, but something is lacking. And so we came to the conclusion that we needed a 4th financial statement, that one being the statement of cash flows. So it basically takes the income statement and puts it back from an accrual basis of accounting to a cash basis of accounting. And again, the resource cash, the asset cash, what you actually have, okay, not what you have promises to get paid, okay? So principle number 2 is money has a time value. Excuse me with this. This is the first time I'm using it. What does that mean? Money has a time value. Well, that means $1 today is worth more than $1 in the future. As you can tell, I'm an old guy, gray hair. What little I have, of course, I haven't had a haircut since the pandemic came in, so it's about a year now. Back when I started working, I actually worked my way through college, but first job out of college, what was I making? I don't know, $4,500 a year, and it was a lot. That was pretty good. I was doing all right. I always had money. Gas was 30 cents a gallon. I brought a brand new 1973 Subaru for $2,610 cash. Today, brand new Subaru would probably cost you around $30,000. Gas is $2.60 some cents. It shot up last week. I wonder why. Anything to do with the XL pipeline being canceled? Yeah, it's up 14 cents, I believe, since the first of the year. That's one of the things, principles that's coming up in a little bit, the efficient market concept, okay? But time, money has a time value. Why is $1 today worth more than $1 a year from now? Because that dollar we have today, we can do something with it. We can invest it. We can make it grow into $1.05, $1.10. Maybe if we're really good at whatever, if we're Apple, we can change it into $2. Okay, so $1 today is worth more than $1 in the future. One of the reasons is the effect of inflation. Okay, $1 doesn't buy today what it bought when I graduated college. Like I said, brand new Subaru was $2,610. Now it's 10 times that, if not more. I can remember, a loaf of bread being, a quarter, 35 cents, whatever. I've seen it in my lifetime. Prices go up because inflation, and costs go up, products come and go, but money has a time value, interest rates, okay? The third principle, risk requires a reward. And this is common sense. Why are there interest rates? Well, because we're delaying immediate gratification with today's dollar. If we put it in the bank and interest rates are near zero now, 1%, whatever. Let's use a 5% interest rate. You put the dollar in the bank or put the $100 in the bank, delay consumption today, come back in a year and you have $105 if the interest rate was 5%. With the $105, you're taking a risk. Will that $105 a year from now buy less, the same, or more than we can get today with $100. Okay. Years ago, I was teaching accounting for another institution, and it was a night class, and young people, but there was one fellow in the class who was about my age. It was kind of strange, talking about an adult. He was very adult, okay, and he was a very good student. And we got into talking about recording assets at cost, and somehow we got on the discussion that land and real estate is a good investment because it never goes down in value. And I said, back in 1972, we had a flood in the area here where Wilkes-Barre was underwater, Kingston was underwater. A mile from the river, we had 8-10 feet of water sitting on Kingston Corners, where the used to be a Burger King. What's there now? The drugstores are there now. If you had a piece, in fact, I have friends who bought a house a little bit before the flood. Let's say $25,000. Again, this is 1972. That was a lot of money. And then the flood came, and their house was not worth $25,000 anymore. I used to be a tax auditor, corporate tax auditor. I worked at some of the larger oil companies doing tax audits. Gulf and who was it? Chevron merged. And I was working with a guy from Texas who worked for Gulf, and he was offered a job with Chevron in San Francisco. Well, in Houston, Texas, houses were fairly cheap, but because of the oil glut at the time, he had a house that he paid $125,000 for, that he had $100,000 outstanding balance on his mortgage, but the market value of the home was $90,000. In other words, he was upside down in his home. And then when he was going out to San Francisco, an area that isn't dependent on oil like Houston, Texas, there was more of a, that was the years where technology firms were starting to develop. Real estate prices were far in excess of what they were in Texas. So if you have a investment, it's a risk. It can go up or down, or it can stay the same. Well, if it's the same, you're losing just because of inflation. So the way you'll, and not always, but the trend is, if you take a riskier investment, you want a bigger reward. The bigger the risk, the bigger the payoff the investor demands. And it's only common sense. Why should I invest in company A if they're promising to give me a 25% return on my investment, where I can go and buy a government bond and get 5% risk-free? Well, I'm risk-free. I know what I'm going to get. With the non-government, with a corporate bond or a corporate stock, and they're saying, the possibility of getting 25% return, yeah, but it can also go bankrupt. Thing is, with the government treasury bonds, and we'll get into those in a little bit in future chapters, they're the benchmark because they have 0% chance of defaulting, because the government can always print more money to make good on the bond, so satisfy the bond at the maturity date of the bond. Okay, so keep in mind, risk requires a reward, and this I don't want to say any one of these principles is more important than any others, but this one is the most consistent and makes the most sense. They are all very important. Principle number 4, market prices are generally right. And under that, you'll see and this will probably be in my shell outline, the word efficient market. What is an efficient market? A market, we're capitalist, free market economy, and prices will settle in, and prices fluctuate based on basically supply and demand, although there are a few other factors. They will settle in where they normally should. Well, they're going to find their equilibrium point. They're going to settle in and be where they should be. What happens when prices go up? Consumers stop buying. Well, the people selling it will realize that, and they say, hey, how do we get these people to buy the product? Well, we got to lower the price. Okay, so it's constantly moving. And, the stock market. It's been going great guns for the last, well, not quite a year. Last March, it nosedived due to the pandemic. And it more than caught back up, and it's ahead by as much as it went down. I believe the market level was around 2,600, or I'm sorry, 26,000 March of 2020. And I think it went down to about 19,000. And I had somewhere June, July got back to where it had been, and now it's around 31,000. So it has made up almost as much as it had lost. Okay, so market prices are generally right. Supply and demand, when down in Florida and a hurricane coming is on the way. You go to Home Depot or Lowe's and try and find a generator, and the one you saw last weekend was $299 and now $499. Supply and demand. The market prices are generally right. Have you ever gone to a fancy restaurant and when you look at the lobster, won't have a price there. It'll say market prices because they don't know what it's going to be when they go down to pick up the lobster that morning or the night before. If the fishermen caught a lot of lobster and they have a lot of supply, people will be benefiting because they're going to be dropping the prices to get rid of it. When they don't have a good catch, and the demand is there, higher price per lobster or per pound of lobster. Okay, market prices are generally right, and what the efficient market concept is that markets operate on information that's freely available to each and every participant in the market, and the market you can get in and out of the market relatively quickly and relatively cheaply. And that's an efficient market, the definition. Best example of that would be the New York Stock Exchange, as I mentioned it in the book. Finally, the last concept, now I'm going to go back and pick up a couple fine points, is what they call conflicts of interest. And this is personal interest, not interest rates. Cause agency problems. So those are in your book. They'll be on my shell outline. Like I advise, write them down on a note card, keep them handy because we're going to be referring to them. The textbook is going to be referring to them chapter by chapter. And what we're going to see is with agency problem, the goal of the firm is to maximize shareholder wealth, not make money, not necessarily make money. We'll get into that in a little bit, but it's to maximize shareholder wealth. Well, most businesses today use the corporate format, and what that allows, there's a lot of advantages, a few disadvantages to corporate format, but what that does is usually owners do not work for the company unless it's a small corporation. When you're talking the ones that are listed on New York Stock Exchange, I own some stocks, and I don't work for any of those companies. I own part of the company, but we have the board of directors and we have professional managers running the company. Now, are their goals aligned with my goals? Okay, they should be, but in the real world, sometimes they're not. Some of these people have very big egos and they're looking to make a name for themselves, and they do what is more beneficial to them than what is most beneficial for me. So they are serving themselves as opposed to serving their owner, me. And that may be cause them to make decisions that will help the company in the short run, increase sales so that they get a bonus at the expense of long-term growth. Short-term growth but over the next 18 months, but over the next 4 or 5 years, it's going to reverse. Okay. So they're looking short term or midterm. I might be looking long term. Again, there's other shareholders that might be looking short term as well. And the managers might be looking mid or long term. So again, there's agency problems, a conflict of interest. Are their goals aligned with our goals? And there's a couple things people can do or companies can do to try and make sure that their goals are aligned. And one of the things is giving them top employees stock options, give them ownership percentage, so that they do act more as owners than as managers. Okay. Let me just back up a couple things here. Okay. Going hand in hand with principle number 4, markets are generally right. You can look at the top of page 4 there, and it talks about investors reacting to decisions management is making and the company makes as a whole, managers individually, is a good thing or a bad thing, positive or negative. Okay, like I said, notice of gas prices spiked in the last week since the inauguration a little bit. Is it the XL pipeline cancellation? It may be, and maybe some other things. Hiking the minimum wage, $15. What's that going to do? I'm sure that every kid, most of the service stations in Pennsylvania are self-service, but they still have to have people there at the counter at the sheets to run your credit card or take your cash, make your change. Well, they're paying them $10 an hour. They got to pay them $15 an hour. That's a big jump. How many? They're open 24 hours a day, 7 days a week. That's let's say 7 times 20, 140, 164 hours, 168 hours a week per one shift. How many people per shift? I don't have my calculator here. It's in the other room. I've got my tablet here though. 168 hours per shift. $5, 0, 4, 3, 5. That's $840 more a week per person, per shift person, 3 shifts a day, 8-hour shift. So say you got 10 people per shift, $8,400. Sheets expenses are going to go up. Well, what does that mean? Well, if my expenses go up, I got to charge more for my product so I can pay my employees. So I'm going to have to raise a gallon of gas a nickel. Things in the economy very rarely are isolated. It's sort of like a domino effect. If something changes, it's going to have an effect on something else. Okay? If costs are going up, what is that going to do? Airline tickets. It's going to cost more to fly the airplanes. Okay, so that's going to push them up. All right. People are going to putting more money to fill up their cars. They're going to have less money to spend on other items, other discretionary items. Okay. Might not buy a new dozen golf balls this year. I might have to use last year's golf balls, whatever. Again, supply and demand, isolation, something, my expenses go up. I'm on a fixed income. I have less money for other things that I want to do, elective things, discretionary things. Okay. Then same thing, you can look at these as a personal viewpoint, or you can look at it from a business viewpoint, because businesses have the same problems you and I have. They have a budget, they got X number of dollars coming in, and they have X number of dollars going out. They have revenues and expenses. You got a paycheck coming in, you have expenses. Certain things go up, that leaves less for other things. Okay, your rent goes up. Well, you eat more rice and beans and toast and less lobster and less steak. Okay, or you start drinking domestic beer and wine as opposed to imported products. Okay, the market impacts, but the market prices are generally right. Now, they're not always right, so it's generally right. They can get distorted from time to time. Right now, the last at least last 8-10 years. I've always maintained that with the low, when Mr. Obama was president, was trying to recover from the recession. So they freed up interest rates to make more, the housing bubble burst in 2008, and credit markets dried up so much so that nobody anywhere could get credit, and it brought business to a grinding halt. That puts people laid off, and you had this thing snowball, and no money in the economy, no money for growth, no money for sustaining the level where we were, let alone growth, and things went downhill. So one of the things they did to stimulate it is we're going to get the Federal Reserve to drop interest rates down to next to nothing, and they've remained there. Now, those rates were, because of political pressure, artificially forced lower than they should be. So the market rate of interest is not truly what we're seeing today. These interest rates we're seeing today are severely manipulated with downward pressure as a public policy. The government is a big player. The government is selling bonds all the time. The price of bonds, the interest rates. We'll get into that in future chapters. I taught this course last summer of 2020, and one of the students was buying a house with her spouse. And we got talking about that a little bit, and he really said, well, this never occurred to me. And I gave him some advice, do this and that and that. And she said, boy, thank you so much. I never thought this course would help me so much in my personal life. And, we'll get to that later on. I'll give you guys the same advice. Interest is a function of two things, the interest rate and the length of the loan. So you don't control the interest rate too much, but you do have some input and control on how long you want to borrow money for. So if you can borrow it for a shorter period of time, it's amazing how much money you can save. And we'll see that in the upcoming chapters. Okay. Okay. The other thing on that top part of page 4, our friends the economists, they like to do this thing where they say, hold all the variables but one constant, and let's see what happens when we change one variable. Well, that's good in theory, but in practice, that doesn't work, because there's no way you can say, well, everything stay the same except this one variable. And again, it's good academic, and it gives us some insight into the predictability and behavior of things, but it is not very realistic. All right. Okay, on the bottom of page 3, we're going backwards, so that confirms that I'm neurotic, I guess. And the goal of the firm, the fundamental goal of the firm, is to create value for the company's owners. Okay, value. How do you create value? Make the company worth more. For years and years and years, wants a topic for their paper. Look at Facebook. When they first came public, their initial public offering, their IPO, I forget, was it $32 or $28 they issued at? And when they first did it, it went up a little bit. And then for the next several weeks, maybe a month and a half, it went down. And then it started a slow climb, and then it got momentum and started to climb faster and faster. And as they say, the rest is history. So when do you buy it? Do you buy it when it was issued, or do you wait a while and see if it went up or down? Stock market's a funny thing. It's the only market, whether you're talking a grocery store or a clothing store, they're markets too. They just sell different types of products. The stock market is the only market where when the price goes down, that is when the market falls, people run away from the market. They start selling because they panic, and they want to sell it at $40 before it goes down to $30, regardless of if they pay $20 or $70 for it. That's a time to buy. Last March, I don't know if it was March, but after it went down, I was hemming and hawing, and I was like, now's the time to buy, So I did. I did make some purchases, and they've already they've turned out well. Again, that's what you want to do: buy low and sell high. When the market goes down, people panic and they start dumping it, and that just puts more momentum and pressure on pushing the market lower and lower. It's like a roller coaster. It goes up and down, but over time, we'll see this is coming up in the chapter. Over the last 100 years, it's returned 10.6% or something like that. If you go back before 2008 with the recession, it was actually the 80 or 90-year return was up around 12% for stocks. That doesn't mean every year you make 12%. Some years you make 20, some years you lose 10. Some years you lose 20, some years you make 3. But over time, the graph goes like this. You can see the peaks and the troughs, but over time, if you did a regression line, it's upward and to the right. So on average, you're making progress. And at any point in time, you can be above or below, but over time, you've got that nice, gentle left to right upward slope. Okay, over on page 4, anything you see in dark, bold type, slow down and read it twice. And also usually give you a definition in the margins, incremental cash flows. What is an incremental cash flow? That is the additional one, cash flow that will become, that will be realized because it is taking a certain course of action. Okay, so we're only interested in incremental. If we do this or don't do this, what's the difference? Okay, opportunity cost, the cost of making a choice in terms of the next best alternative that must be foregone. Okay, I've got $500. I can buy 10 shares of a $50 stock, or I can buy 5 shares of a $100 stock. But I can't do both because I only have $500. All right. Efficient market, we talked about that. Okay. All right. Prices are generally right. I erased it, but you can still in the book there. Generally right. Because I don't know if anybody remembers, again, I don't know your ages, Alan Greenspan. He was the chairman of the Federal Reserve about 20 years ago. So, yeah, probably before you folks were born or realized there was such a thing as a Federal Reserve. And he coined the term back in the 1990s, 30 years ago, with the dot-coms and the tech stocks that rose really fast and then burst, the bubble burst. And he explained it as irrational exuberance, where people sometimes behave irrationally with the stock. They just think, oh, the market is going up, going up, going up. I've got to jump in and ride it up. Irrational. You got to look at they forgot to look at the fundamentals. Can you keep having that growth? No, you look at the chart. You have growth, you have decline. You have growth, you have declines. Okay. So there are people, investors, that are called technical investors. They ignore the company's sales and profits and cash flows, and they just look at volume of stock being sold and how much the market is moving up or down, and they ignore the underlying fundamentals, whether the company has good prospects for the future. And that's what accounting financial statements are all about. It is historic data that we use to project and anticipate future behavior, future occurrences. Okay, how is the company positioned going forward? What are their chances of growing? Okay. Now, again, how do we maximize shareholder wealth? Well, having profitable operations is one way, but again, growing the company. For years and years and years, Facebook, for the first 2 to 3 years at least, their stock went up, but they had failed to make a penny. Same thing with Tesla. Tesla just started turning a profit in the last 18 months. Okay, again, another good topic for a company you want to look at. It's a relatively young, new company. Nike. Nike didn't exist when I was your age. Now it's a multi-billion-dollar a year operation. Okay. Interesting story on Nike. It actually came out of Phil Knight's MBA thesis. He was he was up in the Northwest area. I forget, it was Washington, Oregon. And they're based in Seattle, Washington. He was a runner, and to supplement his income, he was selling running shoes out of the trunk of his car, and he was taking his MBA. I forget exactly what his undergraduate degree was. I don't think it was even in business, but he ended up taking an MBA again. I think he's a CPA. He was a CPA. And his thesis for his MBA was to make running shoes in Asia with dirt cheap labor and sell them over here at exorbitant prices. Get $2 sneakers, sell them for $50 or $100, or running shoes. I'm sorry. And his faculty advisors on his thesis said, "Hey, that's not a bad idea. It sounds pretty good." And that gave him the wherewithal to go ahead and take the gamble and try it. And he got a couple of people together, scrapped up some money, and as they say, the rest is history. How can a guy go from selling running shoes out of the trunk of his car on a part-time basis to multi-billion-dollar a year industry? Okay. All right. Agency problems. Okay, over in the middle of page 9, I have some stuff underlined and in red. Well, in fact, let's go up to the top of page 9 when we're talking about agency problems, conflicts of interest. The way things are supposed to run is the owners should control the company. The owners, stockholders, get votes. You get 1 vote for every share of stock you have. Again, there's other exceptions to that, but that's a general rule. Different classes of stock. You vote for the board of directors. The board of directors, in turn, hires management and is supposed to oversee management, keep an eye on them. Board of directors sets the strategy. They hire managers to do the tactical, the day-to-day operations. Okay. Oftentimes, it works. That's the way it's supposed to work. Oftentimes, in reality, it works just the opposite, where management controls the board of directors instead of vice versa, how it should be. And that's when we have this ugly head. Because sometimes the managers own a lot of stock, they have a lot of votes, and they can control the board of directors. They can get themselves on. In fact, after the Enron debacle of 2000, the government came in with the Sarbanes-Oxley Act and said that the audit committee and the board of directors have to have some outside directors. You can't have a board of directors for a publicly traded company. This only goes to publicly owned companies, not privately held ones. A public company is one whose securities, either stocks or bonds, are sold on an exchange. A private company it's not sold on exchange. We just sell back and forth privately between ourselves or not sell. A public company has to have outside directors on the board of directors, and the audit committee can only be comprised of outside directors. You can't have any employee managers on that committee of the board of directors. Okay, so that has gone a long way towards improving corporate responsibility and corporate governance. But again, we still have a problem with executives that have stock compensation plans, which is a good way to get them to act as owners and for the benefit of owners, as opposed to acting in their own self-interest. Again, they could split. They own 10,000 shares. They said, if I get the price up $10 a share, I can dump it and make a nice profit. And who cares about the other shareholders? I'll retire or I'll go over to a different company. Another way we can solidify some of this is with good auditing. And I said good auditing. Not all audits are good. We've had numerous. I have a textbook. I teach advanced auditing in the MBA program, We use a case study book that is nothing but audit failure after audit failure. Being a former tax auditor, it's a sort of a badge of dishonor, and we keep making the same mistakes over and over again, which shows you how smart we are. Examples, as an example, managers can be monitored by rating agencies, by audited financial statements. Compensation packages may be used to align the interest of managers and the interest of shareholders. Additionally, the interest of managers and shareholders can be aligned by establishing management stock options, bonuses, and prerequisites that are directly tied to how closely managers' decisions coincide with the interests of the shareholder. In other words, what is good for the shareholder must also be good for the managers. But again, you and I, all of us in this class, let's say we own shares of the same company, we may not all have the same goals for our ownership interest. I might be a long-term, you might be a short-term investor. Some others might be midterm investors. Some people might be in buying stock in hopes of getting enough to take the company over and take it private. All right. All right. Essential elements of ethics and trust. It's essential in business. In fact, if you go back earlier, I mentioned the accrual basis of accounting. The accrual basis of accounting says, we're going to recognize revenues when earned and expenses when incurred, regardless when payment is made or received. Well, if we do something and said, you pay me later, we're trusting that the person will pay us later. Okay. If we sell them something, sell them on credit. If we pay on credit, our suppliers are trusting us to pay on time, promptly. Okay. They mentioned Bernie Madoff down there, WorldCom, Exxon, Enron, Arthur Andersen. A lot of bad trust. People not doing what they were doing. People losing sight of the fact of what is right and wrong. Maybe, there's an old saying, everybody has their price. When the price got big enough, Arthur Andersen sold their soul to the devil. And where are they now? Out of business. Okay. They went bankrupt. Okay. Ethical behavior on the top of page 10 is easily defined. It's simply doing the right thing. Okay. Do unto others as you would have them do unto you. The golden rule. Okay. And they give you some examples like, I was reading some articles. Maybe I can somehow get these shared with you. I was just reading an interesting one about the vaccines. Right now we have 2 vaccines out, Pfizer and Moderna. Johnson & Johnson's about to come out with theirs. AstraZeneca and somebody else are about to come out. It was saying that, here's the funny thing. Pfizer is a gigantic pharmaceutical company. I'm not saying they have unlimited resources. Everybody has limited resources, but they are big. Okay? Moderna is a very, 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 very small pharmaceutical company, yet they were able to bring their product to market, and theirs doesn't need the extreme, it has to be shipped cold, but it doesn't need the extreme cold that Pfizer's does. So, what's the difference there? Well, Johnson & Johnson might be the save-all. It's a one-shot. Pfizer and Moderna is a 2-shot to get 95% effectiveness. So Johnson & Johnson might be the late player in the game, but they might end up with the big market share because 1 shot versus 2 shots, 3 or 4 weeks apart. And again, Pfizer is 3 weeks, Moderna is 4 weeks apart between dose 1 and dose 2. Okay. Risk. What's the risk? I've had my first shot. I can go in February for my second. I hope they have it in stock. Now, over the weekend, I got concerned, or Friday, Dr. Fauci said, it may be up to 6 weeks and you still have the same effectiveness. Might have. Well, I don't know. If they come up with 4 weeks, there had to be a reason. Now we're saying it's 6 weeks because the government doesn't have enough doses and they're giving the second doses out to be used as first dosage. What happens in the supply chain? What happens if there's a snowfall, blizzard, and we can't, transportation is down for a couple days, raw materials, power goes out. Risk and return. Every decision has risks involved with it. How much are you willing to risk? Yeah. They're talking about life and death here with the virus. Okay, the role of finance in business, bottom of page 10, three big areas there. Capital budgeting. What do they mean by that? That is how do we plan for long-term investment, building a new plan, coming out with a new product, replacing existing infrastructure. Okay, capital budgeting, large ticket items, capital structure decisions. Should we issue stock to finance the new product line or build a new factory? Should we issue bonds? Should we go to a bank? Should we go to a consortium of banks? Okay. Working capital management. Working capital management is your short term. Capital budget is long term. Working capital management is short term. Cash. Do I have enough money to pay the employees on payday? Can I pay my liabilities off that are coming due at the end of the month? Can I pay the insurance bill? Things, again, you can look at it as a business point of view, or you can look at it as a personal point of view, family thing. I want to get something special for my spouse for birthday or anniversary, Valentine's Day coming up. I got a plan. Am I going to have enough money? Okay. Why study finance? Okay. Strategic planning. It helps you. I'm prejudiced. I tell my accounting classes, I can remember back in my even high school years and college years, always saying in a course, how is this course going to help me? How is this course going to help me? Well, accounting helps you. Everybody's going to have a checking account sooner or later. Hopefully you're going to have a disposable income. You're going to have to decide what to do with that income. You go on a vacation, you buy yourself something fancy, buy yourself a new BMW, or do you want to buy some stock so that later on in life you can have 2 or 3 BMWs, whatever. Okay, everybody has their own. And again, they talk about Daimler Benz, they talk about Chevy going with the investment into the Volt. Yeah, that was a great one, right? Great decision there. How come Chevy, big company like GM, of course, they got battered in 2008, went bankrupt, can't compete, yet Tesla comes out of nowhere. Rivian, if anybody know anything about Rivian, Rivian, I believe it is, they're coming out with an electric pickup truck. General Motors is coming out with an electric version of the Hummer. Again, look what they're doing with it. The early models are going to be top of the line models, $112,000, $120,000 a piece. After they peter that out, then the base models will be available for $75,000 to $80,000. Tesla Cybertruck, 3 models. You got the 2-engine, the 2-motor, and not engine, it's a motor, electric motor. Now you got the one motor, the dual motor, and the tri-motor. The tri-motor being top of the line, and the single motor being bottom. Bottom one is estimated right now to be $39,900. It's a 2-wheel drive, 1 electric motor driving the rear axle. The 2-motor is a 4-wheel drive. I believe that's slotted in at $49,900, $50,000. The top of the line 3-motor. I think they said $69,900, $70,000. So they're going to have them all available at the same time. Why did he come out with the sports car first, premium product? Lower demand, lower supply, built a reputation. Then he comes out with the Model S, big luxury sedan, and then the Model X, big SUV. And then finally the People's Model 3, because at $30,000, there's not as much markup as there is on the $70,000 and $100,000 models. So their marketing strategy may have very well been dictated by their financial forecast. If we can make 100,000 Model 3s or 50,000 Model S's, which way do we enter the market with this new product? Which one is going to give us most gross margin? The upscale unit, more than likely. And that's why I don't know if that's why they did it. Makes sense, and that is what they did do. Come out with the higher price ones first. All right. So we're talking about middle of page 11, just above the middle of the page. There's some italics there. All finance is primarily about the management of money. A key component of finance is the management and interpretation of information. Okay. Interest rates are low, we should be borrowing money. Interest rates are high, you don't want to borrow money. Okay. Like I've said, they're going to back me up here. Finally, an understanding of finance is important to you as an individual. Unlike chemistry, you're going to use finance in your everyday life, or at least occasionally in your everyday life. Of course, I shouldn't say that chemistry. If you make ice cubes, you're doing chemistry. If you're throwing salt on the ice and snow outside, you're doing chemistry. So you just don't realize it. They talk about the different roles and different types of duties people with financial backgrounds can get into in the corporate world. Not that important. Finally, they have a couple things here about the different types of businesses we should know. Page 13, they show you the hierarchy of where finance falls in an organization. So spend some time looking at figure 1-2 on page 12, if you would. And over on 13, 4 ways of looking at organizing a business. Proprietorship, sole proprietorship, it's one owner. Doesn't mean it's a small business. It just means there's one owner, and it's not organized as a corporation. The owner, the one person, owns everything, okay? And they're liable for everything. Partnerships, 2 or more owners. Usually you'll see those with professional organizations, lawyers, dentists, doctors, chiropractors, insurance companies, maybe, insurance agents. General partnership. General partnership, every partner is liable for the actions of the other partners. When any partner can act as agent, once they bind you to a contract and if something happens to them, you are still on the hook as their partners. Okay? You are personally liable for the liabilities of the business organization. Limited partnerships have to have one general partner that has unlimited liability, and then all the rest can be limited partnerships. They are more of a financial backer, owner, as opposed to a employed, actively engaged in the business partner. And it gives you some limited liability for the limited partners. Again, there's got to be a general partner. That one general partner must have unlimited liability. Names of the limited partners may not appear on the name of the firm. Again, they are the silent investor type owners. Third, the limited partners may not participate in the management of the business. Okay, I have a ownership in a limited partnership up in New England, and I bought it recently because it gives a real good return. They don't call them dividends; they call them distributions. And one of the reasons they can do it is partnerships do not pay taxes. The partners pay taxes. The partnership files an informational return, and because it doesn't get taxed, there's, corporation tax rate is essentially 20%. This company doesn't have that expense, so they can give me a higher return. Well, I'd be paying tax on my dividends. I may as well be paying tax on my partnership distribution. Okay, but I get a higher percentage. Okay. Finally, the corporate form of business. Corporation is a legal person. It can do everything you and I can do except vote. Okay. It can be sued in its own name. It can hold property in its own name. And the thing with the partnership is it offers the owners limited liability. The most you can lose as a corporate owner is the amount you paid for the stock. The company goes bankrupt, something happens and they get sued. Once you disperse the corporate assets in settlement of the suit, if there's not enough, they can't come after you personally. With the proprietorship or a partnership, they can come after you personally, except for the limited partnership. The only thing they don't list here is the LLC, which is a hybrid between a limited partnership and a corporation, relatively new, maybe the last 20, 25 years. maybe longer than that, but got real popular the last 20, 25 years, LLC, Limited Liability Company. And in fact, the IRS will allow them to file a return either as a partnership or a corporation at their choosing. Okay. So it's a little bit hard to figure out what they are, LLCs, but do have characteristics of a partnership and characteristics of a corporation. The corporation, as I said, partnerships file an information return, which takes that information and the tax gets paid by the partners on their individual returns. A corporation, being a separate legal entity, legal person, will file and pay taxes on its income using IRS Form 1120 or 1120S. When the corporation pays taxes and then it pays the dividends to the owners have to pay tax on the dividends. Okay, there's some exclusions and lower rates, but again, it's a form of double taxation. So you're getting some benefit from the fact that you have limited liability, but then you also have double taxation. Okay. There's a subchapter S. Oh, there they go. Subchapter S in LLCs. So you can read about those. A subchapter S is a corporation. The S stands for the section of the IRS code. It doesn't mean small. A lot of people think it means small corporation. Most subchapter S's are small family businesses. But the company that builds nuclear power plants, Bechtel, that's an S corp. I believe last time I checked, their revenues were about $35 billion a year. That's billion with a B. To me, that's not a small corp. But you have to have fewer than. There's a whole bunch of legal requirements to meet subchapter S status, but it has nothing to do with size of the corporation whatsoever. Okay. What it does is the S corporation files an information return, and then the owners pay on like a partnership. But again, you have it is not a partnership; it's a corporation. But for tax purposes, you look at it as paying the tax on the shareholder level, not on a corporate level. Okay. So it talks about which type of business should you use, which format, and they give you a little table up on top of 15 showing the advantages and disadvantages and characteristics of each. So it's a pick 'em, whatever suits your thing, your needs, your desires, your wants. And again, if you look at it from a historical perspective, back in the medieval days, everything was the rich landholder. So it was a proprietorship. And then when we started expanding and sending caravans to the Far East, and Columbus wanted to look for silks and spices going the water route, he had to go get financing from Queen Isabella to finance it. So you had people coming together, form partnerships to get capital together. And then when we had the Industrial Revolution, we needed a way to get a lot larger bundles of capital together, and that's where the corporation came from. Okay, so multinational firm, you get hairy when you have different currency translations, and also now we have the International Financial Accounting Standards, IFRS, Financial Reporting Standards, International Financial Reporting Standards, the U.S. is the only country in the world that has its own accounting standards. Let's see, there's 193 or 194, depending on whether you count China as one or two, with Formosa and how you treat Vatican City. But all the rest of the world, of the 160 some countries use the International Financial Reporting. The United States of America is the only one using the Financial Accounting Standard Board standards, and the other ones, I guess, are so underdeveloped they don't have accounting rules. Okay, so last thing I talk about is developing skills for your career. Critical thinking. Wow, that's always stressed. But I'm looking at here. I have a thing here. New ad campaign, hire new employees. You only need two things to do anything: time and money. This course deals with the money factor. Okay. Excel skills, how to use a computer. Again, that's a tool, a very useful tool, but it can be used beneficially. It can also do some damage if you write your data analysis skills. Again, we live in the age of information. There's more information than we can process anymore. It used to be just the opposite. We didn't have enough, but we didn't have the means to do it. And collaboration, communication skills. And it still comes down. We got all this stuff. How do we get this information interpreted and get other people to agree or disagree with us and show the error of our ways, or we show them the errors of their ways? All right, so I'll be sending a link out for you folks to watch this hour and 20-minute YouTube. A little bit long, but I got near the end. I want to get it all in one instead of split it in two. And I'll be sending you some stuff out. Just make sure you do review questions 1-1, 1-2, 1-3. These are also on the syllabus. And the mini case parts A, B, C, D, E, and F. So we'll be checking in with you from time to time, and we'll be talking about Chapter 2 in the next video. Thank you for your patience and your attention.